Hey everybody, I'm Jason. This is Supply Demand Daily. I keep tabs on the economy so you don't have to. Today we're going to be talking about our latest reading on jobless claims, which is going to tell us something about the labor market, and then we're going to go into manufacturing and services PMIs. Now the great thing about Supply Demand Daily is you do not need any prior knowledge whatsoever in order to watch these videos. I'm going to explain what is every single chart and concept that I introduce. Okay, so if you don't know what a PMI is and you're joining me for the first time, that's totally fine. We're going to go through it and we're going to make sure that by the time you're done watching this video, you are going to know what a PMI is and what the significance of it in terms of watching the economy and what it's doing. In order to do all of this, I'm going to go ahead and get out of the way and we will go ahead and get started. Jobless claims and a business activity given to us by PMI data out of S&P Global. Okay, so let's start with that second thing. We got some purchasing managers indices, and I'm going to start with a chart actually, just so you can kind of see visually what we're talking about here. A purchasing managers index is essentially a way of rating whether or not there is growth, contraction, or stability, is in no change, going on in a particular industry or sector. So when we talk about PMIs, which stands for Purchasing Managers Index, it's called a Purchasing Managers Index because this is based on surveys, and those are often sent to managers who are in charge of making purchase orders on behalf of the firm. They can also be sent to different types of managers, of course, and it may not be exactly a purchasing manager filling out every single survey by every single company or on behalf of every single company, but that's where a lot of this information comes from. And so this particular one that we're talking about today comes from S&P, that's Standard & Poor's, a securities ratings agency for a big chunk of the financial world, and this is from their subsidiary IHS Markit, which tracks all kinds of data on different types of industries across the world to help people who like to look at the economy like me and presumably like you. So the way this works is a survey is going to be sent out to, we typically divide this up into manufacturing and services, but you can also have surveys of specific kinds of manufacturing firms, like you could have mining and let's see, textile manufacturing and durable goods manufacturing and cars and all this kind of stuff. But the way that it works is typically any reading that you see that is above this 50 mark, you can kind of look at it as a percentage, that is a set of percentages, but any reading that is above this 50% mark is usually going to be a sign of growth. What that means is that we have surveyed all of the participants to this survey, so we've surveyed a bunch of manufacturing firms, and there are some of them who are reporting growth and increasing business activity. There's some of them who are reporting decreases in business activity. Some of them are reporting no change, but if it's above 50, what that means is that there are more firms reporting an increase in business activity than are reporting a decrease in business activity. So that's why a reading above 50 is growth. And if you flip that, take the other side of that coin, right, and you're below 50, then what that means is you have more firms reporting declining business activity than you do reporting increasing business activity. And this is typically made up of a bunch of different factors within the business, particularly sales, orders, deliveries, the delay in deliveries, the cost of inputs, things like that. All of these things that businesses are particularly concerned about. This comes from S&P Global. I forgot to set my source on that particular chart. But let's go back here to what we saw in June. That's the other great thing about PMIs, is they're often released the same month that the data is for, whereas most economic data is delayed by at least a month. So in June, we got a reading for the composite index, which is a combination of both services and manufacturing. Hopefully I don't need to explain the difference between services and manufacturing, but service is a business, often a business-to-business transaction. It's a thing that is provided between the buyer and the seller that does not include an exchange of actual physical stuff. And manufacturing would be some kind of exchange of physical stuff, whether it's Oreos or cars or plastic bins or something like that. All right, so in June we got a decline of 2.5 50.4 on the composite index. Again, that's services and manufacturing put together. Looking at a level of 51.2, which is just slightly above that barometer that we looked at, that limit that we looked at of 50, readings below which signify contraction or recession, declining business activity in general, at least for the majority of firms. Services, we got 51.6, which is not looking too much better than the composite, which was a month-to-month decline of 1.8. Manufacturing output, we got 49.6. Now, that one did decline considerably by 5.8 points on the index, and that is now in contraction territory. So what remains to be seen for next month is if we see further decline or if that continues to hover under the 50 mark. And my outlook, just given the comments that we're going to go over in a little bit, is that it probably will. So the highlights from June are that these two indices, the composite, again, that's services and manufacturing put together, and services were both at 5-month lows. And this manufacturing output, like I said, it's now in contraction territory below 50. And that is at a 24-month low, which if you just check your memory, back in June of 2020, we were in a pretty serious lockdown-induced recession. So that's not the kind of number that you want to see in a time, what's supposed to be a time of economic expansion and high job growth and all of those kinds of things. So I already showed this chart, but this is just the composite index going back to when data was first collected by S&P Global back in 2007. So you can see the decline here in the index leading into the recession that followed the great financial crisis. You can see the weakness here in 2018 and 2019 when a lot of analysts were speculating and estimating that we would be going into a recession with or without the pandemic. The pandemic surprised everybody, but the recession did not necessarily, and so we saw that in the first and second quarters of 2020, and we see this bounce back and this ramp back up here in 2021, and here we are in 2022. Not looking so optimistic. Sorry, hopefully there will be some more optimistic news to share on this show in the near future. This just is not one of those times. And so I like to look at the comments and the highlights that come out of these survey respondents. So manufacturers fared worse, with factory production slipping into decline as the respective seasonally adjusted index fell to a degree only exceeded twice in the 15-year history of the survey, at the height of the initial pandemic lockdowns in 2020 and the height of the global financial crisis in 2008. At the same time, output charges rose at the softest pace since March 2021. Output charges are what the firms are charging for the things that they produce. So it's what a wholesale distributor of goods might, whoever sells goods to Walmart, for example, might charge for those manufactured goods as they come off the factory line directly from the manufacturer. Firms continue to highlight the pass-through of higher cost burdens to clients, but increasingly, firms stated that offers or discounts were being offered to encourage customer spending and ward off competitors. This is a sign of what economists might call softening demand. If the manufacturing firm needs to start cutting prices and offering discounts in order to rid itself of the inventory that it has created and is spending money to maintain, that means that expectations are that demand will drop, and the demand has indeed dropped in the present time. And so that we have some comments from services too, reflecting the same sort of sentiment. Average cost burdens increased at a market pace in June. We're talking about inputs now, things like labor and materials that it takes to provide these sorts of services. That would be an input cost or an input charge. A supplier, material, fuel, transportation, and wage bills soared again. I imagine there's a lot of transportation costs involved in a great many services around the economy. The rate of input price inflation was the softest for 5 months and eased notably in May, but was much quicker than the series average. Similarly, the pace of output charge inflation softened, as we saw in the previous slide there, for manufacturers, and was the slowest since March 2021, a little over a year ago. Although firms continued to pass through hikes in costs to clients, some mentioned concessions were made to customers. So we see a little bit of discounting in there, not quite as much, not quite as notable as for the manufacturers. And then service providers signaled a notable change in pressure on capacity during June as backlogs of work fell for the first time in 2 years. So they have less work in the backlog, which means as a result, the rate of job creation eased to the softest in 4 months. So we have the job openings slowing down as well. And this reflects what we saw from Target several weeks ago, or a couple weeks ago rather, where we saw reports that in their earnings guidance for the rest of 2022, they told shareholders that they intended to ramp up the discounts in its businesses and the goods that it currently has in inventory, because it is loaded up on inventory in the last couple years, expecting to be able to sell it at higher prices. And because demand is slowing down for its goods, they're not able to follow through with that plan. In order to get rid of the inventory, they have to cut the prices. That's the only way to get people to buy it. And so another anti-notch on the belt of inflation caused by corporate greed. You see that all corporations have to eventually deal with the lower bound of prices, or the upper bound of prices that are ultimately set by their consumers. The people who buy their stuff set the price, not the corporation itself. They have to work within those boundaries, the boundaries of what people are willing to pay. All right, so after that, we're going to move on to unemployment claims. So this is a chart going back to January of 2021 and up now to the most recent week of June 2021. So this would end the week ending June 16th. And we saw the 11th consecutive increase in the 4-week moving average of unemployment claims. Why do we do the 4-week moving average? Well, in this particular metric, there's a lot of noise, a lot of up and down and up and down and up weeks and down weeks in between. So what the moving average allows us to do is sort of take away some of that noise and just look at a more of a stable trend, right? So we're looking at directions here, and taking out the noise between the weeks allows us to do that. So we did see the 11th consecutive weeks without an increase. There was one a couple weeks ago where it was just unchanged. There was no decrease, but we haven't seen a decrease in this 4-week moving average in 11 weeks. So I went through the data and I actually looked at all of the times when there was 10 or greater consecutive weeks of increase in this 4-week moving average, going all the way back to 1967. And what I'm showing in blue here is just a simple count of those times. And the orange shaded area is a recession in the United States. So a time when economic growth goes negative and hiring goes negative and layoffs increase, so unemployment rises. And so basically the pattern that's shown here is usually, more often than not, a 10-week consecutive increase in unemployment claims leads into an economic recession, or means that you're in the middle of an economic recession or kind of recovering from one. There are very few cases within this time series that are not in some way affiliated with an economic recession. And just to point those out, because there's some of them that you can't see very well because they're enveloped by the blue. These are the 1, 2, 3, 4, 5, 6, 7, 8 since 1967 that I'm pointing out here, all having some action with a 10-week or longer increase in initial unemployment claims. So just wanted to set that up and visualize it for you, because if you've been watching these videos for a while, I have mentioned how, the more weeks that you add on consecutively of unemployment claims rising, the more contractionary, the more signaling of a recession, a decline in economic growth, and a decline in total employment, and of course, negative job growth, essentially what that means, the more likely it is that that is what's going on or what's to come. So what am I going to talk about tomorrow? That'll be Friday, June 24th, 2022. We're going to go over consumer inflation expectations, and there was some data released by the Energy Information Agency. That's a U.S. government agency that tracks the oil and gas activities as well as all kinds of other energy generating activities within the country. And so we're going to talk about, are we going to run out of oil and gas before the winter in the U.S.? Energy is a scarce resource, as you probably noticed by how much you're paying at the gas pump lately. This is a global phenomenon, and the United States is increasingly no exception. So we're going to talk about there's been a lot of noise on the news and on Twitter about just how low the supplies of gasoline and different fuel oils really are. So we're going to go into the details and see just how concerned we should be. All right, that's all I got for this Thursday, June 23rd. Hope to see you back tomorrow for Supply and Demand Daily. And if you have any feedback, as always, as to how these shows can be improved, please send me an email, or you can DM me on Instagram, TikTok. I'm on Rumble and Twitter, and a couple other things that I can't think of right now. I hope you enjoy the rest of your evening, and I will talk to you later. Thanks. Have a good one.